Cash pay interest versus PiK interest. What's the difference? Well, not all interest actually gets paid in cash, even though it may appear as interest on the financial statements. Some interest is not paid in cash, but accrues on the balance sheet. This is called PiK interest or paid in kind interest. PiK interest is non-cash, does not get paid by the company, but rather accrues on the corresponding liability on the balance sheet. The distinction between cash pay and payment in kind interest has obvious implications for a company's cash flow, for their liquidity, for your operations, for how much money you can borrow from the lenders. Normally, as everybody knows, interest is paid out of cash and flows through the company's income statement. This is called cash pay interest. PiK interest, or paid in kind interest, is not actually paid. The interest payments are added to the principal balance of the loan, and they're not paid out of cash. The interest payments still appear in the income statement as an expense, but they're not paid out of cash. They are getting, quote unquote, paid by getting added to the principal balance of that particular loan. So how does PiK actually work? Well, in a cash pay structure, the borrower's obligation is straightforward. Interest accrues on the outstanding principal balance, and then the amount is paid to the lender. Scheduled principal payment is made on the date that it's supposed to be paid. Then the principal of the loan, the principal balance, stays flat except for amortization payments. But paid in kind or PiK interest is structurally different. Rather than requiring current cash payment, the lender agrees to accept non-cash payment, have the principal amount grow each month or each quarter. At the end of every month or quarter, the accrued interest is added to the principal balance, growing the base of which future interest accrues. This is not a deferral in the traditional sense. It's a compounding obligation that grows with mathematical certainty. So why does PiK exist? Well, it's a deliberate structural tool that serves legitimate purposes in transactions. LBO or sponsor-backed transactions could be a special situation or a distressed scenario. Could be a seller note in an M&A transaction. Maybe someone is converting their debt into equity and they don't want to have the tax implications of debt forgiveness, so they instead just keep that debt going with PiK interest. But the cash flow statement treatment is particularly important because PiK interest is a non-cash charge, so it's added back to the operating activities of the depreciation and amortization. This can make the cash flow appear meaningfully stronger than it maybe warrants under the underlying economics. Just keep in mind that PiK's a tool. Like any tool, its value depends entirely on the context in which it's used. PiK is additive when it enables a well-capitalized company with a reason to exist that has cash generation capabilities to pursue a particular strategic objective, maybe an acquisition, maybe a recapitalization or a growth investment that would otherwise be constrained by near-term cash interest obligations. In these cases, the compounding cost is more than offset by the value created. PiK is problematic when it masks a fundamental cash flow problem or a fundamental business problem with a business model that's permanently broken. So like and follow, subscribe for more tips like this. Thanks and have a great day.